please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Udayan Mukherjee is also with us. The market has settled 50-point lower on the Nifty and 160 lower on the Nifty Bank. Udayan, good morning. So, we've been talking about, of course, the rupee move and, the intervention and all that stuff. But emerging markets are seeing a bit of a problem. The MSCI emerging market and Asia ex-Japan index down quite a bit this month. Your thoughts on, how things are shaping up?
Morning, Anuj. It's not a bit of a problem, but I think you used an euphemism. I think it's more than a bit of a problem for emerging markets right now. And this steady exodus of foreign money or global money, dollar money from emerging markets, including India, will probably continue through till the end of the year. So we have a tricky fourth quarter coming up now, October, November, December. The liquidity situation for emerging markets is not great, compounded by the macro problems in many of those economies, including ours. So the best case that you can think of right now is that you won't fall too much and the domestic money does not dry up too much. I think that is the most important thing technically for the market right now, because the August figure was not great for domestic mutual funds. I mean, it's a given that we have moved away from the 15,000 crores a monthly run rate that we were seeing earlier in the months of December, January, February. But if we go down to the 5,000 crore kind of a net inflow situation for equities, I doubt whether that will support the market against the steady exodus of foreign flows. So we have a bit of a technical imbalance brewing out here, and the macro news is not great. So as I said, the best case is that the market forms a bit of a trading range. I don't know what that range could be. Maybe it is 10,800 to 11,800, a 1,000-point Nifty range, and try and work with that in the fourth quarter of this year.
Good morning, Udayan. It's not looking good. When was the last that the RBI announced an OMO and the bonds have fallen further by about 25 pies? It's 8.17 the opening versus 8.13. Crude is also lower, so nothing is working except the rupee at this point in time, and the fact that it is 1% lower today, at the moment 72.65. So clearly the steps have been seen as way too inadequate, and I guess you cannot stand in front of an emerging market sell-off. Udayan, I want to look at the longer term earnings. The positive is that whenever rupee depreciates, there is a positive for the local stocks and their earnings. But the negative is an 8.2 yield, and all that happened practically in 4-5 weeks. So do you see an earnings impact, or they cancel one another?
No, Lata, and I think the market's actually been very wise in positioning itself for exactly the twin pressures or the dichotomy that you just described. Because IT has been a rank outperformer, pharma's done quite well, and the market's swift to actually figure out what will get hurt by the rising yields. It's not just the yield. Wholesale funding, of course, will become a big challenge, but actually interest rates will also start rising, because the kind of tepid deposit growth we are seeing in the banking system now, I think it's only inevitable that rates will also harden. Now that is a pressure for earnings. So I've been saying consistently over the last few months that we will not get this 25% earnings growth that analysts are shouting from the rooftops about. It always appeared to me that we'd get closer to 15%, and that was not even factoring in an upward pressure on interest rates. And now that yields have started to move up and interest rates will follow, I think it's going to be difficult to get more than 15% earnings growth. So we are getting some earnings growth. It's not like there is no recovery in earnings, but we'll probably get to that 14-15% kind of growth and not that 25%, which was required to support a market at 19 and 20p multiple. And I think because of the yield hardening and the tempering of the earnings expectation, what you'll probably go on to see in the fourth quarter is a P multiple compression. How severe that compression turns out to be will depend on how the emerging market story plays out globally.
Oh yes, 2.5 minutes left for markets to open. Let me just take Ashwini's thoughts on how the opening should be traded, and what's the 9-10 call, Ashwini?
See, like I said, it's more likely to be consolidation. So I don't think on the index you have too much. If you want to buy, probably buy near 11,440 or possibly 27,000 on the Bank Nifty. I think Balrampur Chini could have another good day, so that's a buy with a stop of 88, target of 96.
What's the stop for that trade, buying at 27,000?
Basically 50 points, 26950, and take it from there.
Okay. Udayan, hi, good morning. You spoke about how domestic money is the key to track right now. What should the retail market positioning be? Because, you know, this morning Goldman Sachs has cut their India target to market weight from overweight after many years. Do you think the time now has come to raise cash levels?
You know, I don't think we have arrived at a point of panic where people should stop their SIPs, because the nature of the beast is such, Sonia, that things average out over a period of time. So SIP is a habit. Once you get out, you're basically back into the timing game, which most retail investors cannot do. So I think for an SIP habit, we'll have to see more evidence of greater damage to conclude that SIP should be stopped. But what is happening right now is that what we like to call the smart or the professional money, that has started to walk out over the last 1 month or so, which is why the lumpy inflows into equity mutual funds are no longer there. Now, whether we'll see large-scale redemptions from these professional investors, that we'll have to wait and see, because the net number in August was lower, but it was still 5,000 crores plus. So SIPs are continuing. I think some money from professional investors got taken out, but we have to watch out for redemptions, the point that you're asking, from the serious smart money in the domestic space. And if that happens, this market will be difficult to support at these 11,300 kind of levels. That number is an absolutely key number now.